Hello, Bareboot traders. Welcome to second episode of Weekly Options. This is a new segment we're trying out where we talk about market overall, what's happening, kind of macro environment trends, and then I'll talk about some of the trades that I did last week, some of the trades that I'm setting up for next week, and things in that nature. Of course, if you're a member of our community, you've seen me trade live options in the chat room before. But if you're not, this is kind of a good taster of what you can expect in the chat room. What a crazy week it's been. I mean, today, let's go ahead and bring up our trading terminal, and this is a tool that we're building by traders for traders. We saw a little bit of a rally going into close almost on all the indexes, and we're recording this on Thursday, by the way. Especially IWM, we almost closed flat on IWM. is one of the more stronger indexes in this recent sell-off. And the reason for that, I talked about this in the chat room, is we're getting very similar market reaction in Europe as well as America. And these markets are becoming really correlated, and the reason for that is war and geopolitical uncertainty. Investors are looking at one another, and we're getting kind of similar results. Whenever Europe rallies, the next day US kind of rally. If Europe sells off, Asia sells off, the next day US sells off. So they're usually not this much correlated, but the correlation is really, really high, especially these days. In terms of sector performance, let's go ahead and take a look at our sectors. In terms of 1 week, of course, energy had this blockbuster move, up 6% in 1 week. The reason for that is, of course, the tensions and oil prices going up. Utilities, which is one of the more defensive sectors, up 2%. Real estate, this is where the yields come in. You got your REITs where they're paying monthly income. Closing is slightly green, and everything else, of course, is down pretty bad. So let's get into it. So let's erase all this and get into the deck and talk a little bit about market. As I mentioned, the energy is going up really high. This is a relative performance between S&P 500 and XLE, so it's comparing XLE and SPY. It's a really good relative performance. You can see energy has been outperforming the index, even though S&P is only about energy is only about 5% of S&P. It's been really outperforming in terms of performance. Now, the question comes with this supply shock and higher prices. What would that mean for the economy? So let's erase these and go into next slide. So every time we've had massive increase in oil prices, in 2008, in the 1990s, right at 2008, almost every time we've had this massive rally in energy prices, this has led into a recession. So the question here is, are we going to see another recession? We know for a fact that we're going to see some kind of economic slowdown, but is it going to lead into recession? My personal belief and idea of this, the way I look at it, is we're leading into a late stage business cycle. I'll talk more about it in the next few slides, but that's how I'm kind of making my trades going into next week, because I believe we're getting into a late stage business cycles. And I'll show you the business cycle of how it works and what sectors actually perform better in a late stage business cycles. There's lots of interesting stuff coming in this video, so definitely stick around. So let's erase these and go into next slide. So same story. So looking at since last week, when you look at the staples, we know a staple is more of a defensive sector, outperformance in compared to S&P 500. Again, of course, there is war, there is tension, there is economic slowdown. So you know for a fact that investors are piling their money slowly into more defensive sectors. Utility, same story. Utility, you gotta pay your bills. It's your gas bill, whether it's your water bill. You have to pay your bills regardless of the economic conditions. So more investors are kind of piling in their money into utility sectors. Let's go into another sector. Let's go into next slide. Healthcare. Healthcare is also another defensive sector. So you can see basically from really beginning in 2022, so start of 2022, from January, healthcare has been kind of outperforming the S&P 500. This is kind of ticking up. We'll see if this outperformance continues, but all of these are signaling that, hey, we are in a late stage business cycle and we're going into a slowdown. Whether or not we're actually getting to recession, that's still debatable, up for debate, but we are heading to a little bit of an economic slowdown. So how do you trade in an economic slowdown using options? I'll talk about it more, right? But that's kind of the scenario. Of course, when we get into economic slowdown, when prices increases, when things are getting hard, people usually cut back on their spending. So it shouldn't be a surprise that XLY, which is your consumer discretionary, so this is your Starbucks, your cup of coffee that you can make at home but you rather buy outside, or your Tesla, your car, anything that relates to your discretionary income, that sector has exactly since the start of January, when we saw those defensive sectors do better, those sectors have actually been lagging a lot, right? And I talk about it, this is kind of a basic macro econ, but you know, if you have your demand and if you have your supply, and let's say you have your long run supply, which we're not there yet, you know, we saw a huge shock into the supply with oil prices, with the war, commodity prices going up. So this huge supply shock is pushing the supply curve here. And of course, demand is going to go down. People are getting scared. War, uncertainty, demand's going to go. So what you actually end up with is something right here. So prices go up, production goes down. This is your kind of recessionary bubble, right? This is kind of the environment that we're heading into. You can kind of see it in the smart money. This is where the smart money flowing. Smart money is going out of discretionary and is going into more of a defensive sectors. And then we're seeing a similar thing in financials. So financials didn't have a really good February. They did a small bounce today, but it's been really rough. And one of the questions that we get a lot is, hey, if the rates are going up, if next week Federal Reserve, about 100% certainty, they're going to increase the rate by 25 basis points, if interest rates are going up, why is financial not doing so well? Why financial is selling off? And that's a really valid question. And the question comes into yield curve. So let's actually go ahead and take a look at the yield curve currently. Let me go to yield curve. So treasury yield curve can tell us a lot of what's happening in the market. So currently, this blue line is the yield curve. You can see the yield curve is completely flat, meaning the difference between the 2-year and the difference between 10-year is not much. It's almost flat. Compared with the same time last year, this was the difference between 2 and 10, a huge steep. Right? A healthy yield curve for financials will look something like this, kind of a contango, right? Because people deposit their money, the bank will borrow at the short term and will lend at the long term, and they eat off this spread. But when this happens and the yield gets flat, this is actually terrible for the bank. Despite the short-term rates going higher, this is actually not good news for financials. And the bond market is signaling us two things. It could be signaling us two things. Yield getting flat, the longer duration yields going down, kind of yield going into that inverted shape. What this could tell us is two things. In near future, we either have deflation or we have a recession. This is what the bond market is telling us, right? That's why the yield curve is behaving like that. So, some people still believe that we're going to see some deflationary forces. I mean, Cathie Wood is in that camp, and some markets kind of participant believe that, hey, we're going to see recessions, we're going to see some serious slowdowns, and we're going to go into recession. So which one of these is, only time could tell. But as a trader, I don't really care about which one it is. All I care about is we're going to see a slowdown, and that's how I want to set up my trades going into next week, going into next month. I want to have that understanding. And that's why I kind of spend a little bit more time on these macro economic events. So let's go back to the slide deck. Of course, fear, corporate yield is widening. We're seeing that. Let's go to the next slide. And this was the slide deck that I was talking to you about. So this is the business cycle. We have your earliest stage business cycle. Economy is doing really good. Things are getting more expensive. Consumers are spending. Consumer confidence is going up. Housing, the lumber is getting more and more expensive. The housing prices are going up. That's usually the peak of business cycle. And then when we come down and then we sometimes fall into a recessionary environment, this is when what sectors actually do good. I personally believe we're here. We are at a late stage business cycle. We're heading into a slowdown. And as a trader, that's how I'm setting up my trades. We already saw energy outperform. I think we're going to see some outperformance in healthcare, in consumer staple, and utility. And we're going to see some, lack of performance and lag in consumer discretionary moving into Q2. So for the next few weeks. And one of the trades that I'm setting up is actually reflective of this belief that I have. Let's erase this and go into next slide. So next week we have the Fed meeting. Fed is going to probably, with a 99% probability, increase the rate by 25 basis points. What this means is, we've talked about this before, if Fed do a fast cycle, meaning start raising the rates really quickly, markets don't like it. Historically, market don't like it. But if Fed actually does a tightening, but do it per schedule, doesn't surprise the market usually rallies during Fed tightening cycles. So it's yet to be seen. This year is definitely a different year. It's more challenging year with the war, but it's interesting to see. It definitely seems like Jerome Powell is not the type of guy who is going to surprise the market. He's been very calculated so far. So let's see. Let's erase all this and go into next slide, which I believe is my trade summaries. Yeah, so these were the last week's trade. I don't know if anybody followed it. I still have these two. These are expiring tomorrow. This is probably gonna expire worthless, which means I get to keep all the premium. So this worked out great. This is cutting it close. Shopify is flirting around that 555, 560 mark. So we'll see what kind of a day is today. Tomorrow, whether or not we get a rally or not, but this is probably gonna lose me money. This mRNA trade that I set up worked out perfect. Tesla Condor worked out perfect, and then the SPY straddle. This was a bet that the realized volatility is going to be bigger than expected volatility, and this actually happened, right? We saw, especially on a Monday, we had a 4% drawdown, and that wasn't priced in. And these kind of opportunities really come even with VIX being elevated at 30. So this straddle actually ended up working out, and I'm still in this hood. I'm keeping this. Again, I said this is more of a merger arbitrage. So let's erase this and going to next slide. What's happening for next week? So going into next week, these are my trade summary. Of course, if I set up more trades, you kind of have to be in the chat room to know when I'm closing these or what other trades I'm setting up. But this is, as far as Thursday, this is what my portfolio, kind of my option portfolio look like. I'm running a relative trade. This is long XLU, long XLV, which is healthcare, and long staples, and going short XLY. So this is a relative trade, and the reasoning is the yield curve, the Fed meeting, all the stuff that I talked about. And my bet is over the next few weeks, 2 or 3 weeks, we're gonna see continued outperformance by utility, by healthcare, I'll put just HC here, and by staples, I'll put XLP, and then we're gonna see some kind of lag in XLY. So I'm shorting XLY and I'm going long these guys. All I'm betting is, even if market sells off, I'm betting that XLY will sell off more than these three. This is a bet on neutral strategy. I've talked about it a lot in the chat room. If anybody has more questions, feel free to email me. My email is my first name, rd@bearbulletraders.com. So you kind of know the drill. bearbulletraders.com. I'm kind of bullish on semiconductors, a bullish spread, ratio spread on semiconductors. Sold the 29 call, bought 232 calls, kind of betting that semiconductors were really oversold in terms of technical, betting we're gonna see some bounce going into next week. Technology has been really down. Sold some puts on TDoc. This was an earning play, DocU, straddle. I'm gonna close it probably tomorrow. The expected move was 15%. At the time of recording, DocU is already down 20%, so I know for a fact that this trade is going to make me some money. mRNA, bullish put spread, 124, 120, so sold the 124 puts, bought the 120 to cover. The reason for that again is I believe healthcare is going to outperform. Unity, 75-65 bull put, and then the hood lips, I still have them. And then I bought some SPY January 23 490 call. Why did I go 490? Because 490 would be 6% return for the year. Based on my model and some of the calculations that I've done, the forward dividend yield of a SPY is about 1%, and the expected earning growth is somewhere about 4% to 7% for the SPY. So took a medium average, SPY could close the year green at about 6%, so these calls could be really valuable getting closer to the end of the year. I'm already up quite nice on these, but if you want to kind of play that round, this is a really good inexpensive way to bet on a SPY closing the year green, even though it's still down 14% for the year. So that's about it. A lot of stuff we talked about. We talked about macro environments. There's a lot of uncertainty, I understand. Let's erase this and let me go back, and I want to show you one last thing. The term structure of VIX is still in backwardation. It's been in backwardation for quite a while. We know that the natural state of VIX is contango, looking like this, going into long-term volatility increasing. But, kind of the traders are betting that, hey, as we move forward, volatility should come down. And that's what this term structure curve is telling you. So usually when this happens, within a few weeks, the bottom should be in. And we still hasn't breached that January 27 bottom. So hopefully some good news comes out. Of course, my thoughts and prayers, I know I talk a lot about market, but of course war is never a good news. My thoughts and prayers are with anyone who's involved or affected by war. Hopefully we get some good news out of that region as well, Europe region, and of course market starts to rally. That being said, that brings us to the second episode of Weekly Options. Hope you enjoyed. Any suggestion, questions you have, either email me or leave it in the comment sections. I try to answer them, and that's about it. See you next week.